Welcome to TheoTrade. This is Don Kaufman. Here we are, October 4th, 2017. What did markets do today? Well, the grind goes on. Well, what do I mean by that? The S&P's grind about 3 points higher. I mean, hey, little perspective over here. That's 0.12%. What's the grind? Well, it's a low volatility grind to the upside, which actually begs the question. I've had a lot of emails lately and people are like, listen, I want to get bullish in this marketplace. Okay, I understand. Why do you want to get bullish? Well, look back over the last 5 years. I could even go further in time, but we'll just take 5 years in this example, which has been for the most part straight up. So understandable that some people want to take a little bit more of a bullish bias to the markets. But I think we all kind of recognize what fate might lie ahead of us. And that fear is keeping a lot of traders kind of at bay. And let me tell you something. So all directional bias aside, all right, it doesn't matter who you are in this business, you should have fear of the downside, like risk versus reward. What do I mean by risk versus reward? I'm looking at the Qs right now, but let's go to the IWM. This is what I mean by risk versus reward. I mean, if you take a look at this, 10, 11% move to the upside, you just draw a straight line off the end of this. You have to ask yourself, what do you think the upside potential is versus the downside risk? Now, we all recognize that the markets are capable of still grinding higher. I mean, I was pretty astounded at 144 in here. What am I thinking here at 150? I'm thinking we could probably grind a little bit higher. And one of the things that's not only apparent to me, but incredibly important at this point is to try to walk you through the idea of let's get bullish, okay? However, we're going to do it in such a fashion that if we're dead wrong, we don't get absolutely annihilated. How could you do that? Well, yeah, sure, you can go out and buy some stock, right? So you can go out and buy a few hundred shares of the Qs, or you could buy the spiders, you could buy the IWM, okay? Or you could buy futures contracts. Hey, listen, there's a whole lot of products right over here, just buy them. The futures contracts are going to give you great margin capabilities, right? Better than the spiders, better than the Qs is their ETF, but I'm going to use the Qs in this example because, again, the Nasdaq's been on this grind to the upside. So how can you get long with not substantiating, inordinate risk? And what do I mean by inordinate risk? Okay, let's lay something on the line over here. You go out and you buy the Qs. I don't care how many shares, whether it's 100, whether it's 1,000, whether it's 10,000. Been there, done that, seen the movie multiple times. If the market is going to sell off, and that's that fate that we're all kind of worried about, right? You're watching the market grind higher for 5 straight years. You're like, And when I talk about fate, you're just tempting, fate over there. You feel in the marketplace on a day-to-day basis right now, and I do. I sit here a lot throughout the trading day. You kind of feel like to me, it's like playing chicken with the marketplace. If you're long the markets, obviously that's a bullish position. You feel like you're running just head on, and sooner or later, a freight train is just going to appear in front of you. So going out and buying stock right now, my biggest fear is that, our clientele here at TheoTrade, they hold stock overnight, and one morning you wake up and the Qs are no longer trading, for example, at, 146. The Qs open up, for instance, at 143 or 142. You get this 4 or 5 point gap, and that can't happen. Of course it can happen. You don't have to look that far back in the chart, okay, to see gap-filled wonderland of the Qs. I mean, here's a day where the day didn't actually start out that way. We started at 144, though, and we dropped all the way to 138. Okay, there are days here that we started out, at extraordinarily low levels. So, the Nasdaq, the IWM, the spiders, let's not forget what they are, okay? And that is the beast lurks within all of these. I mean, you look at something like the SPX, and people have tendency to forget that the SPX, okay, what's a decent size move? People are, 20-point move in the SPX is decent size. No, it's not. A 3% move is a decent size move. That's where it gets statistically significant. A 3% move. What's 3% of 2,500? You're doing some quick math over there, like, ruh-roh, like a 75, 80-point move. before markets really start getting, rocking. So one of the things you can use in the short duration rather than stock, because I don't care, you want to put a stop order in here, you're going to be a sitting duck one of these days at a cash open. And I spent 15 years in the brokerage industry. You think I haven't seen an open before where everybody's stops get triggered? Okay, we call that they puke out of the trade. Right at the cash open, you get filled at the worst possible price and the market rallies thereafter. So rather than use the stock, if you want to get long right now, even if you want to be long for like a month or 2 months, you just want to ride it to the upside, ride the markets to the upside, use at this point like a stock replacement. Now, bullish spreads, okay, are not pricing well. So here's the Qs at 146. We could do like a 145, for instance, 147 spread. I know this is only for 9 days, okay? But just to make a point, here's a spread that's in the money by $1.03, but it's trading for $1.14. That's not like reasonably priced. I can even bump this all the way out to like November. This is now November 17th, okay, expiration. So I could bump it all the way out to November 17th. That's 44 days. It's trading for $1.24. Like, why would you buy a $2 wide spread that's only in the money by $1 for $1.24? This thing is pricing horrifically right now. So using spreads to get bullish, it's not where it's at. All right. And the reason you can't use spreads is there's too much skew. And what skew is the implied volatility of the call you're buying versus the implied volatility of the call you're selling. In this case, you'd be buying, okay, a 13.65 volatility and selling a 12.42. It doesn't sound like very much, but that's one full skew point against you. If you looked at a $12 stock and a $13 stock, you're like, yeah, I get it, man. There's a big difference in there. Well, there is a big difference. This, you can't do it right now because the max you can even make on this spread is $2. Who wants to pay $1.24 for something that can only be worth $2? So if you want a lot of upside potential, okay, but you don't want to have inordinate risk, go short duration, look for right around an 85 delta. Why an 85 delta? It's going to get it done. 85 delta means you're going to get about 85 cents for every dollar move in the Qs, approximately. So you can go out and you could buy an 85 delta option. Now, let me take you through what's called a theoretical pricing calculator. First thing you do, theoretical pricing calculator, hit reset. Okay, always reset it. And I just want you to look at this 85 delta option. Okay, so for example, you're bullish right now and you're like, but Don, I want to be bullish for more than 9 days. I get it, but use a short duration, about a 1 week option. Protect yourself, okay? Be on the down low. If you want to continue to be bullish after 9 days, roll it out, pay the commissions. This is about, okay, protecting yourself. This is about staying alive. Sure, we could grind higher for 2 more months, yeah? Or we could have a wild decline tomorrow, or tonight for that matter. Okay? And you're looking at this and you realize that the market is this powder keg of risk. And it's, surprise, we're going to end up either higher or lower in a given day. But when lower happens, you kind of feel like it's, again, you're playing chicken with a freight train out there. And that ain't going to end well. And one of the things, again, you look at TheoTrade, you got to think about risk first and reward second. And the lowest volatility climate, okay, that we've ever really seen, to pay $3.27. Let me take you through something. Let's say that the market rallied. How much? I don't know. Let's say the market rallied like by $2. Okay. So if the market rallies in the next 9 days by $2, okay, the option in question kind of goes from about $3.31 to about $5.09. Now we could fast forward date. You guys could play around with this, and a $2 rally is well within scope. The expected move is right around $2. Okay. You want to talk about like a wild move to the upside? You could take this thing and move it up further. Here's a $3 rally to the upside. Let's get crazy. $3 rally, you almost double your money. So you're participating in the upside of the market, right? That's what you want. And if you're in the money and you're making money, then you could just take the option and roll it. That means basically sell the option that you're long, okay, and buy another option, okay, a week out and drop it back to an 85 delta. Great. Okay. So what happens if the trade goes against you? Here's the good part of the equation. Okay, let's assume that you're in this position and you go out and you buy the 85 Delta and you pay your whopping $3.30 for it. And the market and the Qs tanks. You wake up, okay, and the Qs are already down, let's call it $3, okay? So your $3.30 option is now worth $1.17. Whereas if you had gone out and bought the stock, you would be down straight up. You'd be down $3. Period. Stock is stock, right? It's Delta is 1. So if 146, you open down at 143, this option though would be worth about $1.17. However, if the market sells off by $3, and $3 is a nothing move, right? The volatility is going to bump up. So let's bump volatility by, let's say, 3 points. Just a little bump in volatility. A little bump in volatility took the option from $1.17 to $1.45. So I'm showing you that's not the end of the world. You're losing a little bit over half of the premium. It's not a complete and total loss like if you were long the stock. And let me show you something more hideous. Want to see hideous? Let's move the Qs down $5. They move down $5. But if that happens in a violent manner, volatility might pop as much as 10 points. Okay, 10 full percent. That's taking volatility from 10% to 20%. Don't think it's realistic? It was just there a few weeks ago. Literally, it was just there a few weeks ago. Look at your option, okay? Your option that was you bought for $3 and basically 30 cents, it's still worth $1.24. Why? Because volatility can actually help the in-the-money calls when the market is falling. And this is just, okay, a quick lesson. This is the kind of stuff that I feel is imperative to talk about right now. I know everybody's infatuated. Where is Google going to go? Where is the XLF going to go? You got to get it through your head. Right now, it's a time to be risk averse. It's a time to think about risk first and reward second. Because everywhere you look, you got to think to yourself, is the risk of getting long right now, is it really worth it? The only way I can answer legitimately yes is if I'm using in-the-money options to mitigate some of those risks. Thanks everybody for joining us at TheoTrade. Have a wonderful evening. Bye-bye.